Hi everyone, and welcome to another episode of Value Investing Talks, where we discuss finance, business, and value investing. I'm your host, Eugene Alexiev, and I bring with me over 10 plus years of experience in running my own businesses. Some of them were sold, and some of them I run nowadays. Additionally, I am the founder of numbfin.com, a comprehensive stock research tool for public companies. At Numbfin, we cover over 60,000 companies listed on 70 plus stock exchanges worldwide. Our platform provides information in 25 languages, offering insights into finance, management, company ratios, and other essential facts. You can find the link to our website in the description. It is also important to note that all the information shared on this podcast is intended for educational and entertainment purposes only. We do not provide financial advice. So sit back, relax, and let's dive into the world of investing. Hi guys, welcome you to another episode of our podcast. And today our guest is Steve Rooms, who is the private investor and is focusing on private equity deals. Hi, Steve.
Good morning.
Could you please tell about what you do and what is your style?
Well, I'm a qualified accountant, and over the last 2 to 3 years, I've moved into private investing as well. So I own a number of businesses, and more recently, I've been focused on the accounting sector simply because that's my background. And I understand how accounting businesses worked. I've worked in accountancy for over 30 years, so it makes more sense for me to sort of focus on that sector.
And you're focusing only on private equity, right? So it's private businesses, not public ones?
Only private ones. I tend to have a criteria that I work to. Within accountancy, I'm looking for businesses that have a revenue between around 500,000, 600,000 up to 1.2. That's the sweet spot, as I like to call it. I look at established businesses that are typically 10 years old or older. Ideally, they will have a management team in place. Not essential, but it's a tick in the box if it has. And if they haven't, then I'd be looking to identify somebody within the existing business who could step up into a more senior role at some point in the future.
I had a question about the leverage buyouts in general, because obviously there are a lot of methods how you can purchase the business. So you can raise the capital from the investors, so you go to the bank or use your own money. And why leverage buyouts? So basically, could you please describe to our listeners what is the best thing about that in comparison to other methods?
With a leverage buyout, the typical structure for a leverage buyout is there'll be an amount paid at completion, and then there'll be so many deferred consideration payments. In order to give comfort to the seller, you're really looking to be able to protect them in some way. We don't look at deals that it's just a win for me. We need to find something that works for everyone. So how do we do that? Well, we'll put a charge over the assets. We've got a sale and purchase agreement in place. We've got various mechanisms that protect the seller. So we'll look at a deal structure that works for both parties. Now, if we need to raise capital, because I've done the financial analysis and I've got the last 3 years worth of accounts and 5 years worth of forecasts, I know exactly what the deal flow, the cash flow forecasts are going to look like. I can then take that information in addition to a business plan that I typically write, present that to potential finance providers. So sometimes I'll put cash into the deal. Sometimes it'll be a combination of my own cash and some external finance. Sometimes it's just external finance. Sometimes it's just we're able to use the existing cash in the business. Not always. It's not a common thing. Not in my experience.
Okay.
So we look at the circumstances, and then by looking at the financial analysis, that will help us to understand, well, do we need to raise finance, or can it be done in a different way?
And could you please tell about how you came up to this? Did you imagine that you will eventually purchase the private businesses?
It's something that I'd wanted to do for quite a while. So if I go back to when I reached 40, I'm 52 now. I always wanted to set up a business on my own. So I'd worked with it in corporate life. I worked overseas. I worked for PLCs. I got involved in mergers and acquisitions during corporate life. And it's something that really interested me. And it wasn't really until COVID that really sort of gave me the push to get more involved in mergers and acquisitions. So I went and learned how to do it correctly. So I sought out the people who could teach me properly. And from there, I then sort of set my stall out and started to find the deals that I was looking for.
We have a lot of questions from our community and personally from myself. Private equity deals is slightly different from the public equities. You have less information about what to purchase. How you deal with that?
We follow a process, essentially. So once I've identified a company I've got some interest in, I'll do some research as they will do some research on me. I want to find out as much about the business I possibly can. So during an initial call, what I'm really looking to do is establish a rapport. I want to know, can I get on with them? Can they get on with me? If that goes well, then what I'd look to do at the end of the first call is to sign a non-disclosure agreement. Once that's done, I then look to obtain 3 years worth of statutory accounts, which would include the profit and loss accounts as well, the more detailed ones. I would want to get hold of the management accounts as well. I can then put that information into a model that I've built, which will give me 3 years worth of historical information. I can then forecast forward what the next 5 years look like. Now, if I know what the next 5 years look like, not only from the existing business, but from additional services that I introduce over time, then I then know how much cash the business will generate. If I know how much cash the business will generate, it then starts to suggest a certain type of deal structure. The model does a number of things. It looks at historically how it's been. It looks at what it could do in the future. It suggests a business valuation and a deal structure.
Do you evaluate some kind of synergies because you purchased, as I am correct, only the accounting businesses? So basically have their multiple businesses in different locations, multiple client bases?
Yeah, so I mean, the latest company that I've bought's got 500 clients. It's based in Yorkshire. And what I'm looking to do is try and focus at this stage is to acquire businesses in Yorkshire, because I'm based on the eastern side of Yorkshire, so it's easy for me to get to them. And then I've got a rollout plan for each one of those. I look at what I've got. I look at the services currently being provided and the staff and the client base. And then we know that over time, we've got some additional business advisory service and other services actually that we can plug into this business over time. Not immediately. I think we've got to do it at the right time. But certainly we've got those additional services that add that value to the company and help to grow them.
And do you change the top management or somehow restructure the business itself? Or you, as the classical Buffett approach, stays as it is?
It stays as it is, and that's important. So I don't change the name. I don't change the structure of the business. There's a reason why it's successful. And I don't want to interfere with that, certainly not over the first few months, because I need to understand what it is that I've got. Some businesses that I've bought in the past, that you can see where there's some improvements to be made. I mean, accountancy, typically accountants are not very good at marketing ourselves. That comes across every time I speak to an owner. And look, there's a big push at the moment, or certainly within the businesses that I've got, to go paperless. And some businesses are still not paperless. They're not using the systems that are out there to make life easier for themselves and for the teams.
Are you considering any other factors like the cultural difference or maybe some particular type of accounting while you consider purchasing?
I look at businesses that certainly offer the range of compliance services. I'm not interested in businesses that offer year-end audits. I think there's just a lot of red tape that surrounds auditing in businesses. So I tend not to want to get involved in businesses that provide that. But I certainly want that core base of standard services where I can see that we can bolt things on to complement what we've already got.
How you deal with the conflict of interest? Because obviously when you purchase the public equities, there is slightly different situation with that. So everything is okay. But when you purchase private equity, especially in one field, this can be the particular risk.
Well, I'm not sure about conflict of interest because every business that I've got operates in its own right. Yes, we've got a group company, so we've got a group structure, but every one of those businesses operates independently. And this goes back to the point that it's got its own management team. It's got the name of the business doesn't change. So we keep it operating just as it was. Now, what we can then do is we can share expertise. And that's one of the good things about having business within one business, for example. We don't provide group structures. We don't provide inheritance tax planning. But in another company, it can. So we can then use that to cross-sell services to the existing client base in a particular business.
Do you purchase the businesses only increase the cash flow at the value of the business, or you consider just to purchase, then scale and sell the business to someone else?
Well, at some point I'd like to retire, so at some point I will be selling the
Okay.
businesses. But we certainly look at the businesses that I look at. I want to be able to identify where I can add value to it.
Yeah.
If it's a business that I see that I don't understand, then I wouldn't go any further. If it's a business where I think it would be difficult for me to get involved and make any changes, then again I'd always think very carefully about doing that. But there's two ways in which I look at opportunities. If it's a larger business of the criteria that I mentioned before, where it's 500,000 to 1.2 million revenue, then I would buy the share equity in the business. If it's a smaller business, for example, where we've got fees of about £100,000, I'd look to take the client base and bring them into one of the existing businesses so we can grow one of the existing companies that way.
Do you see any risks connected to the information technology disruption or maybe artificial intelligence or something similar? There can be some changes in the nearest future.
Yeah, they can. And if we look at we use predominantly Xero and QuickBooks has now got an online version. There's a level of artificial intelligence in both of those products, as well as Next and HubDoc and a few other software, accountancy software. Do I think it will replace the team? No, not in the near future. I don't, simply because businesses who we work with predominantly need that expertise. You know, it's one thing being able to process invoices and doing a lot of the transactional things, but it's that additional expertise and that hand-holding sometimes that a business owner really values. You know, sometimes they'll get to a stage where they can't see the wood for the trees, as the saying goes, and so they can pick up the phone to one of the team. And then in a few minutes, they can kick a few ideas around and come up with a solution. It tremendously enhances what we do, and it particularly has a tremendous impact in terms of marketing. But I think at this stage, I don't see artificial intelligence replacing accountants and bookkeepers and things like that.
So basically, it's more positively affects than negative.
Yeah,
right?
absolutely.
That's great. And do you see any particular trends connected to this particular IT industry, so maybe marketing or maybe different things which are not common for your particular industry right now?
I think when you look at the level of automation in accounting businesses, I think that's unfortunately is lacking sometimes. And you see that with some of the older owners of businesses where the technology has really come to the fore over the last 3 to 5 years. And it's not something that they've ever wanted to get involved in because they're at that time of their careers where they've got a good business. So they kind of settle for that and they don't really want to grow beyond that. But when you look at some of the accountancy products now and the way that you can automate, I mean, I'm talking about things like Go Proposal, Accountancy Manager, Pixie is another good example.
Yeah.
The way that you onboard clients and then manage them, the way that you can store information digitally, you can sign documents digitally. You know, gone are the days now where you've got to print off a set of accounts and send them in the post to the owners for them to sign and send back. You know, those days that should have gone. So that's where now it can really enhance, because the more that you can do, the more that you can harness technology, the more time that it gives you to actually look at what these figures are telling you. Then what you're able to do is provide that the owners of the business with that enhanced advice to help them to take that next stage in the development of their business. It's one thing crunching numbers, but adding the value is where you help them to grow to the stage where they want to be.
Speaking about the investing in general and working with investors in particular, you have the pool of investors, you're attracting new investment or you invest in your own money?
I've put some of my own money into deals, absolutely. I've got joint venture partners. I've got a group of around 3,000 other investors from the background that I've come from the training that I did within M&A.
Okay.
I've got a pool where I can reach out to them. If I've got a particular problem which I'm not sure how to solve, I can reach out and that somebody somewhere knows that answer, which is great, you know, because we don't all know every answer, do we?
And basically for the next deals, you already have the people, you already understand what's the company you're purchasing, right? Yeah,
so we've got what they call deal flow. So that any time we've got around half a dozen businesses at different stage of the acquisition process. Now, the key thing as well is once you've actually acquired the business, a lot of people don't necessarily think about, okay, I've got it now, what am I going to do? So we've got a 100-day plan where over a period of time, we'll do certain things in a certain order to make sure that we don't miss anything, that we don't start on the wrong foot with either clients or the teams. So yeah, we've got a 100-day rollout plan, which is really crucial. And over time, we'll have a team that will go into those businesses. And the key things are business development, practice management, and marketing and IT systems. So we've got 3 people then that have that knowledge, and they will know the processes that we've already got in place, so that as and when we've bought a new business, they can go off and do what they need to do to ensure that all the foundations are there, and then we can start the rollout plan for the new acquisition.
You have the particular system, as I understood. So you have this processes of that. How do you find the deals? Are you working with the brokers, or you just go through the catalogs of firms and connect them directly? Because obviously it's not a huge market.
Yeah, absolutely. So there's a number of different ways you can do this. I think one of my other investor friends, he produced a document where there's 25 different ways to source potential deals. You know, and it's LinkedIn. You can write letters. Writing letters is not something I necessarily do. It's networking events. It's I've got a piece of software called Scorer, which is fantastic, you know, for generating leads. It's other investors. They may come across a deal that's not for them, but think, actually, yes, this is Steve's sort of thing, so I'll reach out to him. It's other accountants, as silly as it sounds. It's solicitors, it's wealth fund managers, all people with clients who may at some point be looking to sell. It's joining LinkedIn groups, Facebook groups. There's lots of different ways you can do it.
You know, in a previous episode, we spoke with Arti. She's the private investor from UK as well. And she invests in public companies. And she just calls to the top CEO management and C-level management and ask all the questions. I think this works here as well. So you basically call to the particular business and just ask whether you would like to sell or not, right?
You reach out to them. And if they put their hand up, metaphorically speaking, and register some interest, then the first thing you can do is set up a call. I prefer to do it face-to-face if possible. It's not always possible to do, but if we can sit down and have a face-to-face, have a coffee together and talk in a relaxed environment, and then we'll see where it goes. And sometimes you'll get to the end of that first meeting. Typically that will be 40 minutes to an hour. You'll get to the end of that first meeting and think, it's not an opportunity for me. Or the seller might think, well, actually, it's not really what I want to do. And that's fine, you know, because there are lots of other opportunities there. If it's something that you want to pursue, then you'll go to that next stage. And this is when we sort of start to look at the commercial due diligence and the financial due diligence and look at the overall financial.
What pieces of advice would you give to the person who are interested in something similar? Because it's obviously not the thing which is broadly discussed in the internet. So it's particular knowledge you need to start or maybe to work with.
Yeah, I think the key thing for me is to go and find the right people to teach you how to do it properly. There's lots of YouTube videos out there. There's lots of so-called gurus who are not gurus and will give you bad advice. When I wanted to get involved in this, I did a lot of research. I came back to 4 people. I know 2 of them I discounted, but the other 2 I actually did both courses. One because it focused primarily on leverage buyouts, and the second one was because it gave me 16 different deal structures, 15, 16 different deal structures. So I've now got lots of different ways that I can structure deals. I've got lots of ways to source opportunities. I know the legal side. I know how to put a deal together. That's paid in dividends because the second course that I did 6 weeks after, I bought my first business using these techniques. So it will stand you in good stead. So if you're going to do it properly and don't try to bootstrap your way through.
Do you have the team for that?
Because my background is accountancy, the financial due diligence is okay. You know, I'm okay with that. I do have a trusted lawyer who I work with, who's worked with me on every deal. So he knows how I work. I know how he works, and we've produced a standard set of documents. So we've got a standard letter of intent. We've got a standard heads of terms agreement. We've got a standard sale and purchase agreement, and we'll take those templates and then obviously we'll put them into the circumstances for the particular target. My key go-to person is my solicitor because the law is not my thing. You know, if I look at a legal document, I'll glaze over. It's just not something I do. But Byron is somebody who's very good, and so he's sort of got my back when it comes to things like that. So he'll do all the legal side of it, and I'll do the financial side. The commercial due diligence, I actually enjoy doing myself. You know, looking at the business, mystery shopping, looking at the website, looking at the testimonials. I like to do all that myself because it helps me to get a better understanding of the business itself.
And you also told that you purchased the first business of yourself with your own money. And could you please share more information about that? So how you did that? Are there any mistakes you did at that time then you understood that shouldn't be done again?
I think there's always things that you can learn from in deals. And the ones that I've done, the first deal, I didn't put any cash into the deal at all because there was cash in the business already and the seller was happy to use that money. It was more tax efficient to do that. Have there been things that haven't gone quite so well? Yes, there are always. I'm just trying to think of an example of one at the moment, actually. One of the things that you've got to be really careful of is you've got to really start to get under the hood of the business as soon as you own it and start having those conversations with the team, especially. Because you need to understand the processes. You've got a brief understanding or a certain level of understanding from the seller pre-completion, but then once you've actually got the business acquired, then start to really do some digging to really get into the nitty-gritty of how the business operates. So there's been times when I haven't done that quick enough, and I think that's come back and it's bitten me on the backside on occasion. Anything like that, and there are things that we do with the rollout program that we've got certain things in the wrong order. And sometimes we've introduced a piece of software a little bit too soon because what we found when we did that, it kind of created overwhelm in the team because the team were really used to working in a certain way that had an owner of the business for a long period of time. Then in comes this new person who wants to make some changes. I think the overriding thing I would say is to spend a bit of time, sort of the first 3 to 6 months, really getting a deep understanding of the businesses that you acquire.
So basically everything can be learned and you need a little money for that. But if you don't have money, it's also okay with such type of deals, right?
Yeah, absolutely. Yeah.
Any final pieces of advice you would like to give to our listeners? Maybe say something about this particular industry or style.
The popular misconception is that how can I buy a business? I'm going to have to remortgage my house. I'm going to have to do this. I'm going to have to sign my life away. And it's not all that. It's once you've actually done a deal. I know when I completed my first deal, it was a little bit of backwards and forwards with solicitors, and we got there in the end, and we got it signed. And I sat back and I thought that wasn't as bad as I thought it was, because the key thing when you're acquiring a business for this sort of size of business that I'm looking at, it's about how you get on with the sellers of those businesses. And when you start to go and having the conversations, you'll find out it's not as bad as you thought, and that it's actually a really good process. I've got a certain way, I've got a methodology that I adopt, and I think if you harness that process and take that through step by step, that will reduce the risk of making mistakes or getting a bad deal.
I see.
But I would recommend anybody to do it because it will change your life. It has mine.
When you go to the public markets, and completely different because obviously there are different styles there as well. So the short term, middle term, long term. But if you need the cash flow and you need sustainable businesses now, especially in this inflationary environment, I think this can be the great solution for that as well.
It can. And the good thing with the sector that I invest in is that the EBITDA of the business, the cash profits of the business, are typically between sort of 28 and 35% of revenues. So you've got a solid, stable business there that generates cash.
Yeah.
So if you've got that position already, then you're going to be able to generate the cash for other potential acquisitions in the future.
I see. Thank you so much for your time. It was really great to chat and discuss these leverage buyouts with you. I hope our listeners will also enjoy this. We will put the contacts of yours in the description. So if anyone would like to chat with you or meet with you about the buyouts, or maybe he or she has the business, they can contact you.
Yeah, I'm always happy to help. So yeah, anybody who wants to get in touch, they're welcome to.
Thank you so much, and we will see you next time.
Thank you very much. Good to see you. Okay, bye-bye.
That's all for today, guys. I hope you really enjoyed the episode and found it useful. Don't forget to subscribe for more. Check out numfin.com and see you next time.